So I have invested in 4 startups so far. The latest one being Glamio Health. So what I want to understand, so when we invest, so normally we get a different type of share like CCPS. Sometimes we see SAFE, SAFE. So I need, if you can just help me gain some clarity or guide where I can read about it. Though I've tried internet, but couldn't get much clarity on this. So a little help would be very, very appreciated. That's the first question, but I have a couple of more for you if you allow me.
Okay,
But
first
let's
let me,
understand this first.
well, let's take one by one. So CCPS is normal preference share. There are, there's a normal equity share and a preference share. The preference share means you have preferences in the next round of funding. Okay, and there are certain other preferences as well. So that is the difference between normal equity and a preference share. Okay, it has higher precedence in terms of rights. Now CCPS is kind of a preference share but restrictive rights, and generally it is required by the startup structure, because if there are 100 investors, and if startup has to go to each investor and take their permission for doing things, it becomes very, very difficult. So restricted rights are there. Obviously some critical decisions have to be taken by the investors. Like I'll give you an example. So StartupLanes, we ourselves are going for next round of funding. Now we today evening we have invited all the existing investors to seek their permissions, right? So if they allow, we'll be having a discussion. And actually what we did is, we, instead of issuing CCPS, we issued equity. I'm talking about StartupLanes, but generally all the founders, they prefer to go for CCPS. No other difference. Obviously it's a preference share, so higher precedence is there. And you talked about SAFE. SAFE means simple agreement for future equity. Now you're not getting the equity right now. It is like a debenture. Obviously not just like a debenture, it is a debenture agreement, right? Wherein you get a convertible debenture. Right now the company is promising you to allot you equity at a future valuation. Generally SAFE is done when the valuation is not defined. Suppose you say, no, I want to give you valuation of 3 crores. Founders say, I want 10 crore. So what they can do is, they say, okay, let's do this arrangement. We'll give you 50% or 25% discount in the next round of funding. And whatever valuation comes, we'll allot you at a 25% less. So that becomes SAFE, wherein you are not getting the equity right now. But to secure, there has to be some collateral, some equity, some asset class issued to you. So that asset class is convertible debenture. That is issued to you, and it gets converted into equity after a specified period of time. And the terms and conditions are noted. It has a floor and ceiling. That means below this valuation, it will not be allotted, and beyond this valuation, it will not be allotted.